Good afternoon, everyone. I'm Brad Elliott, Senior Vice President with CAC Specialty. We appreciate our partnership with Intercom and the opportunity to moderate this afternoon's keynote panel. CAC is an employee-owned insurance brokerage and investment banking firm, providing complex risk solutions to public and private companies and their sponsors. It's my pleasure today to introduce three outstanding companies presenting on carbon capture and sequestration: Carbon America, Frontier Carbon Solutions, and Entropy. Starting off this afternoon will be Carbon America, who offers both immediate CCS project development and an advanced carbon capture technology in development. Presenting for Carbon America is Ashley Ross, Senior Director of Policy and Business Development. Ashley brings 18 years of dedication and experience to CCS across a broad range of experience with ConocoPhillips and BP before joining Carbon America earlier this year. Ashley?
Thank you, Brad. It's a delight to be here. I think it once took me 5 straight days of talking about CCS to get tired of it. So I'll try to keep my time to leave time for my other wonderful panelists up here. So my name is Ashley Ross. I'm Senior Director for Policy and Business Development at Carbon America, where our vision is to make climate change history. Yes, that's a double entendre. We want to make climate change history in the world, but we also want to make a name for ourselves in the history of climate change. Our mission is very simple. We are mission driven. Our mission is to get as much CO2 in the ground as quickly as possible. I was reflecting with some of my panelists as we were outside chatting before, a little bit less of the perfect being the enemy of the good. Let's just get that CO2 in the ground and really get this industry off and running. So a bit about Carbon America. We are a less known name in this space at the moment, but that's kind of been a bit intentional. I'll tell you a bit about our history. So we actually spun out of sort of a parent company or a sister company now called StoreWorks. This is a thermal energy storage technology that, for example, could be sat next to other electricity sources like wind and solar to help offset intermittency. So that's currently actually being installed as a demonstration at a plant in Alabama as we speak. As our engineers were working on that, they realized they had come across a really creative, unique way to capture carbon. So we have a chemical-free, cryogenic carbon capture technology. So I'll talk a little bit more about that as well. It is still in development, and so it's not commercially deployable yet, but we anticipate being ready for the 100,000 tons per annum in the 2023 timeframe and being able to scale up to 1 million tons per annum by about 2024. So while we were developing that carbon technology, the carbon capture technology, obviously there's tremendous ability to deploy CCS now. There's pure streams of CO2 that can be gone after now. There are solvents that are available now. So we don't want to wait to deploy CCS until we have our own capture technology. So we stood up our own project development organization where we will design, build, own, operate, provide up to 100% of the capital for the entire CCS project. And that is, importantly, that is technology agnostic. So we can work with other capture technologies to deploy these projects as quick as the sequestration can usually be developed. As I said, we do have this cryogenic carbon capture technology. It's called Frost-CC. Cryogenic has been a less developed form of carbon capture for a couple of reasons that are sort of more historical. Back in the early days of CCS really taking off in the 2000s, capital was really cheap and electricity was really expensive. And so a lot of the effort went into bringing down the capital costs, bringing down the energy penalties, and it was almost kind of, whatever the capital cost is, the capital cost is. The reality is that we're in a very different world now. We've got a lot more penetration of renewables. Electricity can be much, much cheaper, and capital is actually the harder thing to get. So we put a lot of effort into how we designed this system. So we've got a much smaller CapEx and roughly the same energy penalty as other capture technologies. So that allows us to move through the development cycles much more quickly, getting up through the TRL levels, because it's much quicker and easier to deploy those pilots and scale up demonstrations, as well as allowing us to use some just different materials, right? We're not installing a chemical plant next to, a cement factory, for example. We've also, because we don't have those chemicals, that results in, much advantaged operational costs. We don't have to, be constantly replacing solvents, for example. And we've got some creative strategies around, if you do have higher electricity costs, we've got strategies to potentially reduce those and bring those costs even lower. We anticipate capturing 99+% of CO2, and implicit in our process are two important things. All of the other criteria pollutants come out in separate streams, and we produce transportation-ready CO2. So we don't have our capture technology, and then you have to bolt a compressor onto it to get it transportation-ready. Ours is already producing transportation-ready or injection-ready CO2. Because we also don't need to integrate with the plants, because it is only installing additional equipment next to the plant and plugging into your electricity source, there's very little interference with the plant operations and very little downtime to install our systems. So that's about our capture technology, but as I said, we are still in the development and scale-up phases of that. And we also have this project development platform. So we call ourselves, although my expectations have been challenged on this, the only vertically integrated CCS super developer. Essentially, if someone has a stream of CO2, we are happy to take that over the fence. We will design, build, own, and operate, and hold all of the long-term liabilities associated with CCS, including even for, of course, the lovely state of California requires the sequestration operators to hold liability for 100 years. And so Carbon America offers that full suite, including all of the 45Q tax structuring that it makes to get these projects up and running. So I've realized that perhaps in this panel we didn't really fully cover what is CCS. So we're happy to talk about that, with folks more. But in the time we've got today, wanted to make sure you understand that Carbon America, we offer the full suite of CCS project development and the capture technology, and it really is an exciting space. I was reflecting with my fellow panelists that in the 18 years I've been in the CCS space, it has never been as exciting as it is now. And so really delighted to be here and to speak with you and sharing the time with my panelists here. Thank you.
Okay. Our next company on the panel is Entropy, a global leader in modular carbon capture and storage solutions headquartered in Calgary. Presenting for Entropy is Mike Balenke, President and Chief Executive Officer. Mike has dual roles and also serves as the President and Chief Operating Officer at Advantage Energy. Mike has over 20 years of diverse experience with mid-sized producers in the oil and gas industry. Mike?
Thanks, everybody. Can you hear me okay? Okay, it was nice to be able to follow Ashley. Ashley got through some of the introductory kind of comments around carbon capture as a business. In the past, it's kind of been thought of as an expensive boondoggle for governments and world savers. And as it happens in certain parts of the world now, it is actually economic as a business. And it takes a lot of steps to get there, but I'll tell you about Entropy and how we've gotten there and what we're coming up to next. So what is entropy? I mean, many people know entropy to be the second law of thermodynamics. Too complicated to explain. In fact, I'd have a hard time explaining it myself. It's about randomness and the fact that everything we do takes energy and requires this creation of randomness. And what we're trying to do within entropy is to undo that randomness and take that carbon dioxide that's being released into the atmosphere and put it back into the ground where it came from in an orderly way. So we're a clean tech, pure play company, fully dedicated toward carbon capture and storage and vertically integrated, much like Carbon America. So I came here as well, also thinking I was going to be saying that we're the only ones in the world doing this. But yes, we're a full team from full carbon chain cycle, from taking it off the exhaust stack. This is all post-combustion carbon capture that we're talking. Off the exhaust stack, treating it, stripping the carbon dioxide out, getting it prepared for injection, compressing it up, and then injecting that into a geological storage solution. This is stuff that we've already done now for a dozen years in a pre-combustion sense. We're going to do this now in post-combustion. So pure tech, we're a clean tech pure play, and we have the technology in-house, we have the reservoir engineering and geology in-house, the financing, regulatory, and carbon trading. So we own the technology. We'll talk about where we got that from. We have the expertise, and of course, we have the capital. Capital is probably one of the most important things here. A lot of technology providers have no experience dealing with capital, raising capital, managing major capital projects. So that's part of our business, part of my other job as COO with Advantage. So this is a team that came together from three primary entities. This is Advantage Energy. Advantage is a mid-sized gas-weighted producer in the Montney in Alberta. Very, very low-cost producer, lowest in the business, or at least on par, and there's maybe two of us about the same level, 37 cents per MCF operating cost. Long track record of being a very careful cost controller, both capital and operating cost. But we also have a dozen years of pre-combustion carbon capture, scrubbing carbon dioxide out of raw gas, treating it, compressing it, disposing of it, managing the disposal, and collecting carbon credits, which in Canada is now, it's a decade-old process. We've been trading those carbon credits for a decade, making money off them. So we took all that horsepower that's been doing that. We believe that to do this right, you need to have in-house engineering. You can't just go out and hire some generic engineering company. It doesn't matter how big they are. They're going to do the same thing every time, which is off-the-shelf technology, off-the-shelf chemicals. And the business has evolved. It's evolved a ton, and it continues to evolve every day. It's a game of inches. And winning this game means having the most advanced, lowest cost solution. So it's not about hiring some generic guys to go do carbon capture for you. That's like saying you can hire just anybody to build a house for you. It'll cost the same. Not the case. And ABC, our engineering partners, have a long track record of delivering projects well under cost estimate and at very, very low total installed cost on a per unit basis. We know that from our own experience in Alberta. Not as familiar in the States, but long track record of very, very low costs. And of course, the University of Regina, which is a world leader in post-combustion carbon capture research. They've been doing this for 30 years because they were founded to create an EOR source, to put carbon dioxide as a source for a large oil field in Saskatchewan. So we've partnered with them. We acquired all their technology, exclusivity with the professors, and we've taken all the technology and rolled that into our engineering processes in the manufacturing piece. So a very unique skill set and something we'll put up and compete with anybody out there in terms of energy efficiency and cost structure. And we haven't seen anybody actually get this spot where we've gotten to on a total cost structure. A little background on Canada. This is an example of Canadian data. If you want to look at American data, you just take this times it by 10. That's kind of the way it would probably look. So we have roughly 1,600 total emitters that are doing under 1 million tons per annum of carbon dioxide in Canada, and another 60 that are bigger than that. So, we think, hey, what's the real market here? The total addressable market is mostly the 100,000 to million tons per annum. That's really the part that we're focused on. Now, we have projects that we're working on right now, engineering for, over 1 million tons per annum, but we're focused on the biggest sample set because once you've done this a few times, the lead that you have starts to stretch out. It's about iteration, come up with iterative solutions. Not to mention, on the other side, it's not just about oil and gas. We're actually industry agnostic. We're working on a cement project, a fertilizer project, and so on, power gen projects, and so on. So this is applicable to anything really that has a clean exhaust stream. We try to focus on natural gas as the cleanest exhaust stream. A bit of a diagram. This is a really simple diagram saying this is what we do. We capture the exhaust, we scrub it, we run it through our proprietary solvent, we compress it, we dispose of it. You guys got the point on that. A little bit of discussion on U of R, where the solvent came from. Again, this is all on our webpage if you wanted to have a closer look. But this is where the start of our ability to get to be an economic level came from, is 30 years of research and a chemical that sat on the shelf as a discovery but hadn't been financed a couple of years ago, which we picked up and are completing the research on. And a lot of people ask about storage. What do you do with the carbon dioxide once you have it? Well, as it happens, in North America, we have deep saline aquifers suitable for carbon dioxide storage over much of North America. So we know that pipelines can be a solution where needed, and we're happy to work with pipelines, but the only way to keep your costs down really low is to have local storage. Minimize your compression, minimize the cost of pipe, and by the way, if you're taking photos, this is online too, entropyinc.com. Okay, this is just a small group. Hey, we gotta have some fun here. It's the end of the conference. I know booze, we're the only thing between you guys and booze in half an hour, so I'll try and keep it fast. Anyway, there's lots of saline aquifers. We have been disposing of carbon dioxide and H2S into saline aquifers for a dozen years with advantage, but decades across the basin. This is something that has a very specific skill set that's required, and it takes money and time to get that. We've got that in-house. Again, I'll skip past this one. What's it look like in real life? Well, we're constructing our first commercial carbon capture project right now. It'll be on stream in March of this coming year. This first phase will be about 50,000 tons per annum. The second phase will get us to 182,000 tons per annum. That puts advantage, and this is on an advantaged gas plant. All of our production going through that gas plant put us in a unique spot where we could focus on it. All the eggs in one basket, right? So when we're done this, advantage will be essentially net zero 2 years. Think about that for a second. We're not making promises for 2030 or 2050. We can be net zero in 2 years. And so can you. If you have the cash. No, if we have the cash. This is a little bit on cost structure. I'll skip past it again, but just to note, what we're talking about here is an already under construction project, and we're on target to meet or exceed our targets for total cost, which is essentially $400 per annum. It's $400 per ton per annum of capital, and about $15 per ton of operating cost. That's how you get to those project economics that work. And beware people that talk about the cost of carbon capture. There are many different ways to obfuscate the true costs. Okay, so this is modular. The way we're doing this, low cost with the Advantage project at Glacier, low cost, modular. You bolt it up next to your compressors, which is where the exhaust stacks are. You're good to go. We talked a little bit about our revenue streams. Revenue streams in Canada come from carbon offsets. There will also be an investment tax credit. There will also be a clean fuel standard, which looks like the low carbon fuel standard from California. Those are on the come. Carbon offsets are going to go to $170 per ton in Canada by 2030. That's the government's stated objective. So a very lucrative investment as soon as you start to see those costs going up that high, much like what you see with LCFS in California. The promise to pay 45Q is a fantastic floor, which helps you secure the projects with debt if you need to. Okay? Profitable, under 50 bucks a ton. Now this is Canadian dollars. Make note of that too if you can. I've been talking quick, but Canadian bucks, under 50. Our break-even cost is really closer to 35 US dollars when you don't include the disposal piece. Okay? And then just I'll leave you with one slide here. To me, this is about the team. The technology is really important, but this is a complex business. If you're in the energy business, you would never hire someone to go and develop your oil field for you, right? You have that in-house expertise on the drilling, completions, pipelining, facilities, marketing. You have to do those things in-house and get good at them. Our team is built around that process about in-house expertise and being the leaders. And we now have over 1 million tons per annum of projects, 6 different projects, under MOU with third parties. And that's just the start. In order to finance those projects, we'll be coming to market here in the coming quarter, raising some, a few $100 million or something. So hopefully that's not too far into my time. Did I run over a long way? I'm okay? All right, I'll hand it off. Thanks very much, guys.
Thank you, Mike. Our next company on the panel is Frontier Carbon Solutions, founded this year as a joint venture between Open Water Capital Partners and Silver Creek Midstream. The Frontier platform is dedicated to developing sequestration infrastructure across the Rockies, led by a diverse group of energy leaders with extensive CO2 infrastructure, pipelining, and capital markets experience. Frontier partners with emitters and capturers to offer sequestration solutions. Presenting for Frontier is Robbie Rocky, President and Chief Operating Officer.
Thank you, guys. This is exciting. There's a lot more people here than we expected, and I hear there's a ton online. So grateful for all y'all that are here and for Intercom for adding this to the panel. I'm sure you've heard the enthusiasm from us. We think carbon capture is at a real tipping point and represents probably the most exciting energy investment opportunity out there today. As Brad mentioned, I'm Robbie Rocky with Frontier Carbon Solutions, and we are a unique partnership of energy leaders focused on advancing decarbonization through sequestration. And I think you've heard this a few times, the importance of a partnership and a complementary skill set. And I think even more than traditional oil and gas, CCUS investing requires this really strong mix of complementary skills. You've got infrastructure, you've got technical discipline across a lot of engineering fields, and you've got the ability to execute in a pretty nuanced project finance market. So earlier this year, we partnered with the folks at Silver Creek Midstream, one of the largest pipeliners in Wyoming, to build out a team that could deliver these sequestration services. Collectively backed by Tailwater Capital, we marry a strong reservoir operations and capital markets experience with the critical engineering, facilities, and pipelining we need to go to an emitter and give them a sort of a complete sequestration tailgate to tax equity solution. So clearly we're all excited about CCUS, and I think if you take a step back, it's a really fascinating spot. It sits right now at the heart of kind of rapidly changing technology. You've got massive support at all these policy levels, and then this capital market just crystallizing almost real time around this low carbon economy, and that's paired with all the tailwinds in this space are just going to make this an increasingly investable platform for energy investors. It's not all roses. There's kind of a carrot and a stick thing going on here. So we'll start with the carrot piece first. And the big piece of that is federal policy. Carbon capture across the industrial sector is about the only thing U.S. politicians can agree on. And so you're seeing a lot of uniquely bipartisan support to advance this. And the biggest driver is the 45Q tax credit. And I'm sure that's been discussed today. But just to kind of reiterate, the tax credit has been around for quite a while, just never at a value that was terribly compelling. Earlier this year, the credit value was increased to $50 per ton of CO2 captured via sequestration and $35 per ton of CO2 captured via utilization. And that's great. All of a sudden, there's a threshold of projects that are economic. But I think is even more exciting than that is that almost immediately on the heels of those rules getting defined by the IRS, new legislation was introduced to raise that to 85 and 60 respectively, and introduce a direct pay component. So let's take a step back, right? $85 per sequestration and $60 per utilization. There's a whole suite of carbon capture projects that are pretty economic all of a sudden. And direct pay is really important because it eliminates the risk and the fee leakage associated with a tax equity financing. The other thing that's really exciting is state policy, and we talked a bit about this. I think the first thing is primacy. Typically, Class 6 sequestration permits were the purview of the EPA, and they took, best case, 4 years to get done, which is that's a hard sell to your private equity partner when I'm just saying, hang out, fund my team for the next half decade while we try to get a Class 6 permit. 2 states today have primacy. There's 3 more in the application process. And under primacy, a state can issue that Class 6 permit on a much more accelerated timeline. We're hearing kind of a year to 18 months, which that all serves to continue to accelerate this process. Kind of 2 other really interesting things have occurred just in the last couple weeks at the state level. We've seen legislation introduced in one state around post-injection capture. To 10 years post-injection, you can put that liability to the state. So we mentioned California, right? 100-year post-injection monitoring. This is unfinanceable. If you know that you have a 10-year threshold post-injection and you can pass that liability off, that's a major driver for the insurability of these projects and the commerciality of them. And then 2, a state has introduced draft legislation to advance carbon offset credit via sequestration, kind of market approval. So carbon offset credit markets are this other thing, and that takes me to the third piece here, which is this capital markets. Offset credits are kind of like a 45Q tax credit. They're created when a ton of CO2 is reduced. They're sold in 2 markets, the voluntary market and the compliance market. And a great example of this is the airlines, right? So the next time you buy a plane ticket, when you go to the purchase side, scroll all the way down, right? There's your price, there's the insurance you can buy, and at the bottom of that, you have an option to buy carbon offset credits to offset your carbon footprint. Airlines are vast buyers of carbon offset credits, both in the voluntary and compliance market, particularly if they fly to Europe, and they make some of those available to us as customers. So alongside things like carbon offset markets coming together at 5, 10, and conceivably even higher prices over time, you've got traditional capital markets leaning into space. There's a massive shift of institutional equity pivoting into these ESG-themed investments, and just no shortage of your right-way banks and your kind of traditional alternative credit providers leaning in to deploy capital into the CCUS space. And then there's kind of the stick, right? So compliance markets are increasingly part of the emissions toolkit. that folks are using, and that's usually accomplished via a carbon tax or a carbon cap. I think Europe is the best place to look at this. They have one of the most established carbon compliance markets out there. So most every industrial emitter in the EU has an emissions cap. If they exceed that cap, they have to either pay a tax or go into the market to buy these credits. So the emissions trading system, as it's called in the EU, is designed to put a price on carbon, and it covers about 40% of the industrial market. Today, that price in Europe is 58 euros a ton. It's like 65 bucks a ton in USD. So, when you think of the impact of a compliance market like that emerging here in the US, it gets economically debilitating, for industrial emitters. But even, come much closer to home, Canada's Supreme Court just upheld their carbon tax proposal. The state of New York is currently debating a statewide carbon tax. And so I think the takeaway from all this is that there's a lot of positives in place now and kind of in short order to help emitters adopt CCUS ahead of what feels like kind of a lurking compliance market out on the horizon. So in the capture chain at Frontier, we're not focused on capture technology. We are focused strictly on providing a turnkey sequestration solution for emitters, and we call that kind of tailgate to tax equity. So in a right way CCS project on the left side here, you've got your emitter. That's where your volume dedication comes from. That's where your site lease comes from. In the center is your carbon capture technology provider. This is your big capture facility, your flue gas, your process gas cleanup. And then I want to sit right at the tailgate of those folks, and we can provide project capital upstream if necessary, all the sequestration design and engineering, all the regulatory underwriting and approval, and probably most importantly, monetization of the 45Q tax credits and the carbon offset credits. And this is key because the bottom right is where those credits are generated. The credits aren't generated when you capture, they're not generated when you clean it up. They're only generated when you can check the box they were geologically stored via sequestration. So being able to generate those and then monetize them for the highest value in the market and pass those proceeds back up to the emitter, that creates this financial incentive which is necessary for adoption at the emitter level. So today, right, let's call it 40 million tons a year that we're abating kind of across the space. The most conservative estimates have that needing to increase about 100-fold, to achieve our decarbonization goals. So how do we scale it and improve commerciality? And I think it's a bit of a circular process that begins with increasing adoption from industrial emitters, increasing carbon prices, emerging utilization. These are the things that are going to create those revenue streams for emitters. And then pairing that with a full service, almost easy button solution is what they need for acceptance. Continued public and private investment alongside this increased adoption is just going to lower capture cost. But scaling all that with the development of infrastructure and carbon storage hubs is really key for emitters, knowing that at the downstream of all this, there is a safe, very long-term storage solution for their CO2, removes a key roadblock and concern for those guys. And when they do that, when you have the ability to say, hey, we have a home for this for, effectively, infinity years, that removes that roadblock, which increases adoption, just accelerates kind of this path to commerciality. So, and it might kind of hit on it. When you look at the world, I think the United States is probably the most compelling decarbonization target there is. It's, we have three really big themes that are going to drive CCUS forward here. The first is, and I love it because it's an intercom, right? CCUS, every piece of it is a core competency of the oil and gas industry. You've got managing downhole risk, deep well sequestration, multi-state pipeline infrastructure, complex, project finance. These are the things that our industry has been doing very well for decades. So we should be positioned to be leaders in this space. Emerging capital markets, paired with improvements in carbon price are creating that financial incentive to get these emitters to adopt and lean in. And lastly, with this massive support lined up, at a policy level and part of this low carbon economy, I think we're going to see carbon capture costs continue to decrease across the board. And so as we look at the space, turnkey sequestration solutions paired with capture solutions, that's the critical piece to accelerate adoption at the emitter level, and most importantly, deliver that demonstrable CO2 mitigation that we're all after. So that's my time. Appreciate it, guys, and thanks for staying around this afternoon.
Thank you, Robbie. So we've got several questions for our panel today. So maybe, Mike, you start us out with this one. So is CCUS necessary part of net zero, and why?
Net zero, that's a tough, not a question I normally answer.
Okay.
Maybe I'll hold that back here. How's that? Yes, so net zero, I mean, I think net zero is going to be tough to get to without nuclear. So I just would start with that. And I'm not a nuclear guy. The amount of energy required in the growing population, I kind of feel like until we have nuclear, you're probably not going to get there.
Okay.
So I don't want to operate under the premise that I'm thinking we can get there with carbon capture. Certainly, we're not getting there without carbon capture, that's for sure. And there's no, when you think about the way that the world energy mix has moved lately, fossil fuels still retain the same market share that they had 20 years ago. That's not something that everyone talks about, but fossil fuels, same share as 20 years ago. Think about the amount of money that has been spent to try and eliminate that. Hasn't happened. So it's because of efficiency, right? If you talk about any carbon capture solution, it has to be energy efficient. That's why it's so important to have your process locked down, get the cost down as far as you can. And then once you've got it low enough, where it's not creating a parasitic load on your actual generation of energy from burning something, then you can do that everywhere. There's no reason not to. It takes a lot of capital, there's no question, and there's a lot of capital that's pursuing it. But no, I mean, realistically, unless you expect people to live in caves and mud huts and stop heating their homes or air conditioning their homes, traveling, working, tough to imagine any real gains coming out of the entire kind of carbon movement without massive moves in carbon capture. And that's kind of what you guys were talking about. It's a massive, the amount of attention on it right now, the amount of capital chasing it right now, it's huge.
Thank you. Robbie, anything else to add to that?
Yeah, I think what I just follow on to Mike is, with 45Q, we've moved beyond altruism to a place where you can really pencil out an IRR, and that's the most important thing here. I think we're cooperative capitalists here in the United States, so when you can provide that financial incentive, either via an offset credit or a tax equity or some other mechanism, that's what's going to get this adoption over the hump to the next stage.
Ashley?
Just to say that overall, CCS is not the only decarbonization solution, and it will never be the only decarbonization solution. And I'm trying to remember the exact number, but IPCC studies have said CCS is anticipated to offer to sort of 10 to 15% of the globe's overall decarbonization solution. And without CCS offering that, the overall cost to bring down emissions across the globe is considerably higher. So it's possible, it might be possible to get to net zero without CCS, but it's going to cost a whole lot more. In many situations, decarbonization via CCS is actually the most economic thing you can do.
Great, thank you. Robbie, how about you take the next one? How is policy changing the adoption of carbon capture across North America?
That's, with 45Q moving upward and potentially even moving further upward in this next round, you're seeing, here's a great example. We're fortunate to have really kind of forward-thinking private equity sponsors, but that's indicative of the type of capital looking at this space, and they only look at this space if there's serious IRR to be realized. The other thing I'd point to from a policy level is more than $1 billion of appropriations just next year for CCUS, just in the existing infrastructure bill. And so you're seeing the support at the federal level, the state level. Everyone is sort of lining up to find a way to do this, and what they're waiting on is like we talked about, these project developers to show up and say, all right, I'm ready, I have a real project. Let's, and it's probably via these public-private partnerships, let's accelerate this and work with, the large-scale emitters to make meaningful change to greenhouse gas emissions. And we look at the Rockies, which is a 200 million ton per year target, and so you can start to eat the elephant one bite at a time there, and it gets pretty meaningful.
Thank you. Ashley?
Rocky's exactly right. The passage of 45Q enhancements made a tremendous difference and really kickstarted so much more activity in the CCS space. But at the same time, it's not just policy driven, right? When we were all talking about climate change, in the mid-2000s, it was very government driven. It was very policy driven. And now what you're seeing is a lot more social and community and stockholder and shareholder pressure. So there are folks who are, willing to do these with, thinner margins than they would have otherwise, and folks who are willing to do it even absent, the sticks from the government. So the policy has been an incredible enabler, but the non-governmental kind of community pressures to deploy CCS is making a big difference as well.
Yeah, I think in some ways, just to use policy slightly differently, I think all 45Q, all Canadian carbon tax, all European cap and trade, it's all in some way just a different version of a policy, which is we're going to pay you to dispose of our waste product. So in some ways, it's entirely about policy, purely, and that policy can be good policy or it can be bad policy. In a lot of cases, you have government policy picking winners, letting people lose. We've seen that now. There's been a few projects out there of world scale, like Boundary Dam and Petronova, where government picked winners, or where at least the financiers picked winners from an idealistic perspective, not necessarily pragmatic, and they haven't turned out that well. So what we really want to see is a policy that rewards winners, and where losers get pushed to the side. 45Q is brilliant that way because you get paid per ton that you sequester. In Canada, we've got great policy right now for the carbon tax, but instead of having a 45Q style floor for pricing, we're likely to get an investment tax credit, so you get rewarded for spending money. So in my experience, being rewarded for spending money results in spending lots of money, not necessarily succeeding in the goal that you're trying to really achieve. So policy is going to be all over the place for sure, and you can see actually California, honestly, California's right now, you're seeing this right now, where you have Oxy, who I know Oxy with their low carbon ventures is doing work on direct air capture of all things, which is the most energy intensive way. The best way to burn a bunch of energy is to store a bunch of carbon dioxide, which is created while you're generating the energy. So it's a bit circular, but what they're doing is they're taking that carbon storage in the EOR form and creating a low carbon fuel, which they can sell into the LCFS market and get their $200 a ton or whatever the number is. So again, California forging the way on policy is creating this market just ahead of most other jurisdictions. So policy, absolutely critical. Hopefully it's the right kind of policy. It's not picking winners and letting the market decide who's best at it.
Thank you, Mike. So Ashley, what are the challenges to large-scale development here?
Dollars and time. As we've been talking a lot about capital markets today, because that has been, sort of a key thing to get into the CCS space, is really getting investors interested, getting the banks comfortable with investing in CCS projects. When we're talking about the subsurface, all of us here in this room are comfortable talking about the subsurface. It's, bread and butter, oil and gas, right? When you're talking to a bank about subsurface risks, that's a completely different thing. When you're talking to, some farmers running an ethanol plant with a stream of CO2 that are interested in, taking care of their CO2, that's a very different conversation. So getting the investors comfortable with CCS projects has been a big difference. And the other thing is simply time. We're all kind of familiar with the time it can take to develop a subsurface project, right? I mean, unconventionals can happen really fast, but big infrastructure projects can take 5, 10, 15 years to get developed. And it takes some time to develop even simple sequestration projects, and sometimes people think, oh, there's this tax credit out there and they're investors, why can't I get CO2 in the ground tomorrow? It's like, well, you have to shoot seismic, you have to understand the geology, you've got to drill a test well, you've got to permit a pipeline, perhaps. These projects take a fair bit of time. And so even after the tax credits got passed, people are saying, okay, why isn't this industry up and running yet? And so, we're getting the capital it takes to get these things done, but it also simply takes some time. And that's why we're delighted that there are so many people active and engaged in this space these days, so that we can get as many of these things developed as we can and really demonstrate what this technology can do and what this industry can do.
Thank you. Gentlemen, anything else to add?
Yeah, and one of your parts of your question was about large projects. And I mean, that's certainly, we've intentionally avoided starting with large projects until you actually have a bunch of existing projects that are running. You've refined those projects. What you'll find is in large projects, as an engineering company, you have to have a large engineering margin. You go out there, you look at a major coal-fired power gen station doing 1 million, 2 million tons per annum of carbon dioxide. To build that, the engineering company will come back and say, this is what we think we can do it for. there's going to be government backing, there's going to be tax backing, there's regulatory backing. It's going to take a long time, and to make sure that it works when you go out and build it, because you can't turn back, they're going to put in a big fat safety factor, engineering margin, right? That's what we all call it. So because of that engineering margin, you might have overspent by 40% just purely to be sure that it will work and do what you said it would do, but you might miss the things along the way that all these challenges that happen when something's a new technology. So instead, we prefer to start with, you go smaller, 50,000 tons per annum, something like that. We're talking $27 million now on the first project we're working on. We're going to have that running, and we're going to be running testing on that for the second quarter of next year before we run our own solvent through it. We're going to have all the benchmarking down, all the operational parameters down, so in our second phase, we can squeeze that engineering margin to zero. So that second phase is going to be the cheapest. And we'll see the same thing. We're in the process of doing an oil sands once through steam generator, like a boiler basically, that burns natural gas. Do a small one first, then do the rest of them. And we're talking about like the rest of them, because it's the same exhaust stream coming off of those. So we'll have that hopefully up and running with, it's not yet FID, but we're going to try and FID that within the year. And same thing with natural gas turbines, right? They're all over the place. They all have exactly the same off gas, same stream of emissions. So start small, refine it, get better every time. It's iterative. Knock out every joule of wasted energy, and eventually it's just something that goes on every emissions facility. Think about a catalytic converter. Remember acid rain from the 80s? Well, catalytic converters are on every car now. Let's make sure we try and build stuff now that has carbon capture on it too.
Yeah, what's adoption, right? It's time, it's money, it's scale, and I think the last thing that's incumbent on our industry is education. Steam boilers are a great example. Steam boilers are used in a whole lot of industrial processes, and being able to sit down with a cement facility, any industrial emitter, and I think this has always been the purview of clean coal in the past, but all these other emitters, and say, hey, we have a solution for your CO2, and guess what? There's a path that's turned into potentially a revenue stream for you, and take them away, even educating beyond that to stateside engineering firms who have a tendency to just look at pretty historic data versus some of the really rapid changes that are happening in real time in cost of capture, scalability, and modularity, and the things that are going to shape the next iteration of carbon capture technology. So that's a great space with a lot of things changing that I think are going to facilitate this major acceleration of adoption.
Okay, thank you. So Mike, can we use existing infrastructure to move CO2?
Sort of. I mean, it's not great. You're talking about moving CO2 only in that question. Yeah. I mean, for us, we don't want to put CO2 into pipes. We want to put it in the ground. And every pipe that gets built is extra cost and extra compression required, extra friction loss as you transport it. So you can retask certain pipes. You want to have, obviously, you need 900 ANSI pipes, and everything's got to be built to that spec. And you're moving it super critical, 15 MPa. So it actually, gas and liquid kind of looks the same at that pressure. You can try it, you can do it. What we're finding is that the horsepower of compression is one of the most significant parasitic loads. So the more you lose in the pipe, the more you lose overall, not to mention the cost of the pipe. So yes, you can retask it, but frankly, I think when Entropy talks about carbon capture, we are screening dozens of projects at any given time, and we're always looking for the project that has a deep saline aquifer right there.
Great, thank you. Ashley?
Yeah, it's a good question. Yes, we can move CO2 in existing infrastructure. There are some CO2 pipelines in the U.S. Thinking, though, that those CO2 pipelines were generally built to take CO2 to oil and gas fields. So that means that where that CO2 is going to is riddled with wells, right? And yes, you can stick that CO2 into existing, EOR floods, and it can be permanently sequestered and stored through EOR processes. But if you're looking to do something that is pure sequestration, or can qualify for some various incentives in the higher levels of 45Q, the ability to develop pure sequestration adjacent to those CO2 pipelines where they've been poking it full of holes for decades and decades is challenging. and on top of that, there's not just the technical issue around, those fields generally having a lot of holes in them, but the rights to store CO2 in the subsurface are not well defined. Some states have defined it, most have not. And in many cases, and including in places like Texas, right, you very, very oil and gas friendly. There's big CO2 pipeline, the Denbury Green Line that goes to Texas. But anytime you're dealing with surface owners and mineral rights owners, and you've got to try to get pore space agreements from all of these folks, and there's very little framework and kind of template with which to do that. That creates an extra challenge associated with moving CO2 in existing infrastructure that also then represents the cost. So possible, not always the smartest thing.
Thank you. Robbie?
Yeah, some infrastructure is inevitable. You called it challenging near an EOR field. As a CO2 EOR guy for most of my career, I'd call it an awful idea. So when we look at, one of the things we're focused on is sequestration hubs, in a place like the Rockies. And so you're going to have something akin to a hub and spoke approach where you've got a main trunk line, to your core storage field, and you're spurred out to your various emitters. All that is rated at, a much higher pressure to handle CO2. But the idea is that you do your best to do it in areas that have already been previously disturbed or already on existing right-of-way. So, the surface footprint of something like a sequestration site is much, much smaller than an EOR facility.
Great, thanks. So Ashley, coal's been a main focus of CCS research historically. What other industries are large emitters, and how can we decarbonize those?
Yeah, so in the mid-2000s, there were some studies that came out that kind of looked at the wedges of CO2 reductions. Everybody was talking about the CO2 wedges at the time, and they were essentially looking at, kind of forecasting CO2 emissions reductions and where those emissions reductions were going to come from. So this is related to that CCS offering that 10 to 15% of global carbon reduction potential. And within that CCS wedge, they looked at it, and then this was kind of at the time, right? Coal-fired power was still the direction everybody was going, even in the U.S. And then so they looked within those wedges and said, coal is the big prize to go after. Coal is the big elephant to go after. So that got everybody thinking about coal, and all of the funding, at least within the U.S., has been through the Office of Fossil Energy and Coal at the Department of Energy. And so that's created this historical kind of focus around coal, and a lot of the technologies, were kind of branded clean coal at the time, even though they've got much broader applicability. And so things have really shifted now. So yes, coal still represents a huge chunk of things that need a solution, especially for India and China, right? The U.S. might be different, but India and China are still building those coal-fired power plants. But in the meantime, there are all of these other industries that can reduce CO2. Cement, steel, ammonia, some natural gas processing. There are a lot of other industries that do emit CO2, sometimes in already pure streams of CO2 that can be sequestered, some of which have much lower purity and require capture solutions. So there's plenty of opportunity even without it being coal.
Thanks. Guys, anything else?
Yeah, on coal, I think there's an interesting component there. Tax equity, in most cases, it can't be used by the emitter, and so it needs to be monetized. So I've got to go find someone who will buy my tax equity. Coal and fossil derivative tax equity, I think, is going to price at a really wide discount. So that's going to challenge project economics around some of these things, versus cement or steel or other industries that are just, in a sense, perceived as less fossil. Same thing with carbon offset credits. The origin of those offset credits really determine a lot of the value, and so being able to decarbonize some of these other industrial industries is going to be key. Now, you look at what Mike's trying to do and scale those businesses on cement, on steel. That's going to drive a lot more kind of capital markets value to those projects.
Anything else?
Yeah, just to jump in, yeah, absolutely. Cement's, you touched on something great. Cement's like 15% of carbon dioxide concentration, very high concentration. Coal's the toughest of all, has the most sulfates, nitrates, arsenic, cyanide. I mean, the particulates in there alone destroy your solvents. It's really, really expensive, tough to run. That's the reason why those two different, like Boundary Dam and Petronova, failed. So what you want is a clean stream, number one. What's the cleanest burning fuel, nature's best fuel? Natural gas. Notice I'm not a nuclear guy. I'm promoting natural gas. So that's what we tend to focus on. But the actual, like the clinker for cement, for example, is a source of carbon dioxide, chemically derived carbon dioxide. Fertilizers, ethanol, ammonia. And we have project scoping happening on every one of these. And what we're seeing is a reversion to the mean. We think we can do all these types of projects that have clean fuel, clean emissions, at a fairly similar price level. So more to come on that.
Thank you. So Robbie, what reaction do you get from emitters when you approach them about a CCUS solutions, and how does utilization come into play?
Yeah, so education, I think, is the big piece of this, right? Conveying to emitters that there is an economic solution today that's not, $100 a ton. Utilization is a big part of that. And when we think about sequestration hubs and building the associated infrastructure, you can't finance it all off tax equity because the 45Q expires in 13 years. So as much as I want to run some sort of out-year assumption on what the price of that carbon will be, it's pretty challenging. And so utilization, we view as a supplement industry, even alongside direct air capture, as a supplement industry alongside kind of traditional emissions capture for these sequestration hubs to just support the long-term economics of operating a facility like that without having to wake up, 13 years from now and, tell an emitter, hey, we're done. There's no more tax credits. I'm going to put this in your lap, and you've got a $25 million a year OPEX bogey you got to deal with going forward. So I think that, utilization is going to play a bigger and bigger part of this. And, well, that industry is kind of in its infancy right now. Really fascinating things around aggregates and nanotubes and things like this that are coming. And it's just, alongside capture cost falling, that this policy support and these capital markets investments are going to drive, major growth in the utilization market over the next decade.
Anything else?
It depends a little bit, or my answer kind of depends on what you consider utilization. Some people think of utilization as EOR, and there's we're all kind of familiar with the potential there that might hold. But a lot of folks obviously get really excited about these concepts that turn carbon into something, right? You can turn carbon into baking soda, and you can do that economically as long as you have the market to support that kind of baking soda supply. Right? And so what happens with a lot of these technologies that turn carbon into something is at the scales we're talking about of, kind of a standard commercial CCS project is 1 million tons a year. A lot of these utilization technologies are at the tens of thousands of tons per year with very little ability to scale up the technology or the market to support those products, right? Because if you're producing 1 million tons a year of CO2 worth of baking soda, what are you going to do that market? So it's kind of a lot of the market fundamentals of the utilization are really quite challenged. And I think some of the more interesting things to watch is around the aggregates, ideas that take the carbon and turn it into kind of aggregates and cement and concrete components. Because that's actually, the first or second most widely used kind of commodity or material on Earth. So I think that's a scenario where you might be able to get to reasonable scale, but otherwise sequestration, the potential is just, pure sequestration, the potential is orders of magnitude greater than utilization.
Thank you. Mike? Good. Anything else?
They did a great job.
All right, thanks. Okay. All right, so our next question. Ashley, maybe you start with this one. So how did your company come up with this technology, and what makes it unique?
So as I mentioned, our company initially evolved from some technology that was working on thermal energy storage. So the idea that you've got intermittency in electricity, so how can you store it for when you need to deploy that more? And so they started really getting into those thermodynamic processes and really studying heat pumps, and kind of stumbled upon some creative thinking around this cryogenic carbon capture technology. And what makes it unique is we are using the flue gas or the CO2 stream as the auto refrigerant, so we don't have a lot of fancy chemicals. We're using all commodity materials, and it's designed to be as retrofittable as possible. So we think that offers some real advantages. But that said, as CCS is just going to be one part of the solution, a lot of people have been thinking that there's going to be one capture technology that is the solution. And I think it's really much more likely to be a portfolio, right? It might be Mike's technology for natural gas. It might be our Frost CC technology for coal-fired power plants. So I think that there's it's going to be more of kind of matching the particular needs of the emitter than one technology that's going to win it all.
Okay, thank you. Mike?
Yeah, so for us, this is basically just decades of experience with pre-combustion carbon capture and the construction and operation of those facilities and disposal. And then serendipitously, we stumbled across the U of R's technology, which had been developed as part of it was the product of probably a couple of decades of research. It was sitting on the shelf, needed more money to finish it, basically. So we were lucky, a year and a half ago when we stumbled upon it. Nobody cared about carbon capture. So we picked it up. So really, serendipity. Can't take any credit, and I wouldn't call it Mike's technology.
That's great. Robbie?
Yeah, I'm a state school engineer, guys. We are really good at compressing CO2 and shoving it deep in the ground, and our whole business is pretty good at partnering with folks like Carbon America and Entropy to find, like you said, the portfolio, the best kind of carbon capture solution for each unique situation, and pairing that up with sequestration to kind of true CO2 mitigation.
Great, thank you. So we've exceeded our time, so I'll wrap it up with one last question. So how do the commercial arrangements work, and how does this result in profitability for your company? Maybe Mike, you want to start with that?
Sure. So we're actually in the process of many commercial negotiations with emitting parties as well as ourselves at Advantage. And basically, one of the key things about investing in carbon capture is you need to know that the resource will be there for enough period of time to get your rate of return, right, from the investment, which means you actually have to develop some sort of promise to deliver carbon dioxide. So the emitter is committing to give you their carbon dioxide for probably 20 years, 15, 20 years, some long period of time, probably forever as long as they're producing, but they have to have a minimum run time for that plant. So pretty critical commercial term right there. Are you going to be producing carbon dioxide for decades? So we focus heavily on that. And then on top of that, what we do is, and this is because we're financing these projects ourselves, we walk up to these emitters and say, hey, we like your specific emitting facility and the location of it with regards to a disposal zone. We want to build this at no cost to you. So the only thing they have to do is promise to emit. We spend the money, we build it, we operate it, we own it, we collect the carbon credits, we monetize the carbon credits, we deal with any of the commercial terms and regulations. All that complicated stuff, let's make that easy for you. And in some cases, and in Canada in particular, where a carbon tax is rising rapidly and quickly, some people are going to be worried about what happens if because you'll still have that liability. If they're emitting to us, they're still emitting. They're still paying carbon tax, right? This is not the carrot, this is the stick. So if carbon price gets high enough, then the liability of that carbon price in the future can shut them down. So we actually offer a share of our revenue stream above a certain carbon price to ensure that the emitting facility, the industry itself, is protected from being shut down due to the carbon intensity.
Great, thank you.
Yeah, we think of it almost identically. Yeah, I think a drill co is probably the best analogy, where we sweep a big chunk of the 45Q and offset credits up front, and at some point after we've received a target multiple on our invested capital, the emitter can share in kind of the balance of the credits, and that's what provides that economic incentive to them. And you said makes it attractive for these guys to adopt CCUS.
Thank you. Ashley?
Yeah, essentially the same. There are only so many revenue streams available for these projects, and so figuring out the right frameworks to share them. And so we're in that same point of commercial negotiations with various emitters, and I have to say they're also all looking quite different, to be honest. This is a bit of the Wild West, and so everybody is doing things a little bit differently. And there's a variety of folks out there who you know, you can pay them a certain amount and they'll go design and install, and then hand you the keys and walk away and leave you hold all of those long-term liabilities. And then there are folks who are willing to do, you know, the design, build, own, operate for the long haul. And so there's really a pretty diverse set of business models out there for those of us that are working in this space.
Great, thank
If
you,
I could
Ashley.
just add one thing. By the way, one thing that people kind of like, and especially outside of oil and gas, is that you can sell. So this is a cement plant, and this is firsthand experience. We told the cement plant that we're working with that when we're done, they'll be able to sell their cement as net zero cement, which for them,
That's a home run.
here's the keys. Right?
Yeah. Great, well, thank you. Well, I'd like to thank our panelists for their presentations, today's engaging discussion, and being part of the 26th Oil and Gas Conference. Thank you.
So just a couple quick announcements. In order of importance, from least to most. Drinks will be downstairs at the bottom of the escalator at V's. Please come join us for a conversation. Second, would love to thank our sponsors for this event. They're listed here. Their support tremendous in helping us get this done. Next, thank you for all of you that are here in person, that are also online, that joined us over the past 3 days, and all of our presenters. And lastly, I'd love to thank my staff for working endlessly to get this done. No small feat, so thank you all.